I need you to stop whatever you are doing right now. Close the other tabs. Silence your phone. Ignore the notifications, because what I am about to explain is not just another market update, not another headline that will vanish from your feed by tomorrow morning. What happened in the silver market over the last 72 hours is a structural rupture. It is the kind of event that divides history into before and after. The kind that separates those who recognize the signal in real time from those who will spend the rest of their financial lives asking themselves how they missed something so obvious. Silver has just broken $80 per ounce. $80 is now etched permanently into the charts. It is no longer speculation. It is no longer theory. It is a fact. And if you think that number is just a psychological milestone, a temporary spike, or a move that will simply correct back to normal, then you are fundamentally misunderstanding what is happening in this market. Because the real story did not begin when silver touched 80. Mainstream financial media rushed to label it a correction, a cooling-off period, proof that the rally had gone too far. But what followed was not a normal retracement. In China, the epicenter of global silver demand, only pure-play silver investment fund in the entire country collapsed by 10% in a single session. That 10% was not just a bad day. It was the maximum allowable daily decline. The circuit breaker tripped. The exchange was forced to halt the selling because the pressure was so intense that it could not be allowed to continue. And then came the moment that should make every serious observer sit upright. The fund manager issued a public warning. The person whose entire career depends on selling silver exposure told investors the gains were unsustainable. They urged caution. They capped new subscriptions. They changed the rules of the game in the middle of the game. When the person selling you the product tells you the product is overheating, you are not witnessing a top, you are witnessing fear inside the system. Not fear of prices falling, but fear of the structure breaking. China's silver pressure cooker. To understand why this matters, you have to understand what this fund represents. The UBS SDIC Silver Futures Lot is China's only dedicated silver investment vehicle. If you are a Chinese investor who wants silver exposure without physically stacking bars in your apartment, this fund is your only option. That monopoly means that when Chinese investors turn bullish on silver, all that demand floods into a single pipe. And flood it did. 10,000 yuan turned into 32,000 in 12 months. That is not a normal return. It is not even an exceptional return. It is the kind of performance that reshapes portfolios and rewires psychology. During that same period, Shanghai silver futures rose only 128%. Still historic, still extraordinary. But that leaves a 92% gap between the fund and the underlying asset. At the start of the month, the premium was 7% elevated but manageable. By midweek, it exploded to 62%. Investors were paying $1.62 for every dollar of actual silver value, a 62-cent toll, just to hold paper claims on metal they would never touch. In a functioning market, that premium would be arbitraged away within hours. Traders would short the fund, buy the futures, pocket the difference, and crush the spread. But the arbitrage never came, because there isn't enough physical silver to execute the trade. The paper market has detached from physical reality. The price you see on your screen is no longer the price of silver. It is the price of paper promises referencing silver. The real price to actually acquire metal is something else entirely. That disconnect is why the fund manager slammed the brakes. Starting in December, they slashed new short-term subscriptions by up to 95%. They effectively told speculators to go away. Fund managers are paid to attract assets. Turning away money is the opposite of their incentive. It is like a restaurant turning customers away during peak dinner rush. You only do that if the kitchen is on fire. They point to the 10% crash and declare the top is in. They argue the warning proves smart money is exiting. They insist anyone buying here is the final bag holder. Before that 10% drop, the fund hit its maximum daily gain 3 days in a row, 3 consecutive sessions where prices rose so fast that trading had to be halted. The so-called crash was not a bubble, popping it was a release valve after an unprecedented surge. The fund manager's warning wasn't a prophecy. It was legal insulation. Disclaimers are written by lawyers, not crystal balls. And yes, a 62% premium is insane in a normal market. This is not a normal market. China has implemented export restrictions on strategic metals. Industrial demand is exploding. Inventories are collapsing. Solar manufacturing alone consumes roughly 170 million ounces of silver every year, and that number is growing at double-digit rates. There is no substitute at scale. You either use silver or your panels fail. AI data centers are consuming silver at rates analysts did not model even 2 years ago. Consumer electronics quietly absorb hundreds of millions more ounces every year. Total demand is roughly 1.2 billion ounces. That leaves a structural deficit of up to 250 million ounces per year, 5 years running. The cumulative shortfall since 2021 exceeds 800 million ounces. Those ounces came from inventories. Why higher prices are not optional. You cannot just flip a switch and produce more. New projects take a decade or more to come online. That leaves only one balancing mechanism: price. Price must rise high enough to ration demand or unlock recycling. And $80 is nowhere near high enough to do either. This is why Elon Musk's response to China's export controls was so blunt. Not good. When the world's largest industrial consumers start worrying publicly about supply, the market is already late. Paper chaos. Physical reality, paper markets can crash 10% in a day. Physical metal does not behave that way. Try buying silver today and see what you actually pay. Those premiums are persistent. They are not collapsing. They are telling you the truth. The spot price is the fiction. The premium is reality pushing through the cracks. Bears love to invoke the Hunt brothers, but that comparison fails. Back then, speculation drove demand. Today, industry does. In 1980, interest rates were 20%. Today, they are falling. In 1980, U.S. debt was under $1 trillion. Today, it exceeds $34 trillion. The macro environment is inverted. Short-term, volatility, violent pullbacks, headline, panic. Medium-term, the paper price rises to meet the physical reality. 92,120 by 2026 is not hype, it is a long-term. The green transition, EVs, and AI overwhelm supply. There are no new mines coming to save the system. The only solution is dramatically higher prices. Paper silver is a casino. Physical silver is ownership. The opportunity window is narrowing. The days of $20 silver are gone forever. The days of 50 are gone. 70 may already be history. Do not chase premiums. Do not use leverage weight for fear. Buy when headlines scream collapse, because this is not the end of the story. It is the middle. The $80 print was the headline. The 10% crash was the exclamation point. The 62% premium is the truth underneath. And the silver market has made one thing unmistakably clear: the old rules no longer apply.